Hello and welcome to the January 29th, 2010 video version of Invested Central's Chart of the Day. I'm Tom Bowley, Invested Central's Chief Market Strategist, and it's my pleasure to provide you with today's Chart of the Day. This Chart of the Day is brought to you by StockCharts.com, simply the web's best financial charts. Well, today we are featuring something a little different. We're taking a look at the intraday 60-minute chart on the S&P 500. And we're going back 6 months from back in the early part of August 2009 through January 28, 2010's close. And what I want to point out here is really the power of some of the intraday signals that we get, especially if you like to trade frequently and you're trying to get short-term directional movements in the market. I think many times the 60-minute divergences can play a significant role in this process. Now, 60-minute divergence is really no different than a daily divergence. It's just that you're spotting it on a different time frame. So you're looking at a shorter time frame in terms of the chart. If you go back to the middle of September, you can see how the price of the S&P 500, when it was slightly higher, we got up to about 1075 around the 17th or 18th of September, and just a week or so later, we were up over 1080. So we had higher prices. But if you notice, the MACD was much, much lower. So what it tells you is that in the short term, even though prices are moving higher, you're starting to lose momentum. The MACD, the moving average convergence divergence, is the difference between a 12-period moving average and a 26-period moving average. In this case, it's an hour chart. So we're looking at a 12-hour moving average and a 26-hour moving average. So the difference between those two is the MACD. So as your price is going higher, you would expect that the short-term moving average is actually going to rise faster than that longer-term moving average. That's what normally happens when prices go higher. But when you get a negative divergence in place, the opposite actually occurs. You get higher prices, but instead of getting a diverging MACD, you get a converging MACD, which is where the moving averages actually are getting closer. So all it is just an indication that you're starting to lose some momentum, even though prices are putting in a high. So take a look at these negative divergences that I've pointed out here, and this goes back over the last 6 months. You can see higher prices here, negative divergence. Higher prices here, negative divergence. Higher prices here, negative divergence. And what happens? Well, we see drops after each one of those, some a little bit more significant than others. You're not really trying to forecast how far it's going to drop. You're just looking at the forecast as being, or the top being identified by this negative divergence. So many times they'll only play out because it's a short-term chart, they'll only play out for maybe 1, 2, 3 days, something like that. But they can be longer. You need to look to other technical indicators to try to figure that part of the puzzle out. Now, the exact opposite holds true on positive divergences, where you're seeing lower prices, and all of a sudden the MACD stops going down. So you have lower price and a higher MACD with that lower price. Positive divergence, and you can see the market respond, moving higher. Now, I mention all this because right now you're seeing prices continuing to drop, but on the 60-minute charts, we're actually seeing a positive divergence develop here. Now, prices could continue to go down a little bit further, and this MACD might come down a little bit, but still be a higher low. So it doesn't mean that it has to turn right at this minute, but I do think that we're getting close in terms of seeing a bottom. Also, many times these divergences, positive or negative, can coincide with the sentiment indicators that we've been talking about recently. Namely the equity-only put-call ratio, which sometimes shows us relative pessimism or relative optimism. So we try to combine all this to come up with what we believe is a pretty good indication of what the market is going to do near term. So short term, I think based on this positive divergence, we could see the market rally here in the near term, but please pay attention to these volume trends, because if we do break lower and volume is heavy, we have to respect that. I hope you've enjoyed our presentation today. Be sure to check out our chart of the day every day at InvestedCentral.com. While you're there, sign up for our free weekly Market Pulse newsletter and have the chart of the day emailed directly to you. Happy trading.